In today's video, I'm going to walk you through a way to pay your tithe to your local church or to make a charitable contribution from your IRA tax-free. If we haven't met, my name's VanLandingham. I'm the founder of Paresis Private Wealth Management, where we help clients design and implement their ideal retirement plan. So in today's video, we are going to discuss the Qualified Charitable Distribution, or the QCD. Now, keep in mind, there are a couple of stipulations. First, you have to be age 70 and a half. So the year that you turn 70 and a half is the year that you can start utilizing a QCD. And there's also limits or caps. So for 2024, it's $105,000. That's indexed for inflation. So those are a couple of stipulations that you need to keep in mind. Where we see this a lot is with our clients that are in their 70s. Some of them are taking RMDs already, and they tithe to their local church, or they give to a charitable organization. And by utilizing a QCD, we are able to lower their tax bill and increase, of course, their after-tax cash flows. So let's walk through an example of how that works. In this example, this is very simplified. And of course, this is not advice. This is not investment, financial, or tax advice. Reach out to your financial advisor if you have any questions or think that this may pertain to you. But this is a single filer, and they have total income of $90,000. And they pull about $10,000, so a little less than $1,000 a month from their IRA, and have a total income of $100,000. Now, they just take the standard deduction, and their total tax for the year is about $13,850. So their after-tax income is $86,150, and from that they pay their tithe, and it's about $10,000 a year. So their total after-tax income is $76,150. Now, when we look at this example, and if you noticed something here, it's the amount that they're taking from their IRA is the same that they tithe. Now, this may not be the case for you, and if it is different, the math still works out. You may take more than that, your RMD may be more than that, but you can still, whatever the amount that you donate to charity or whatever your tithe amount is, you can utilize the QCD in this manner. So let's look at what that looks like if we utilized a QCD. So again, same thing, $90,000, but now instead of taking the $10,000 from the IRA as just a regular distribution and having to pay ordinary income taxes on it, we utilize a QCD, and this doesn't have to be a lump sum. It can be monthly, quarterly, so keep that in mind. So we utilize the Qualified Charitable Distribution. This goes directly to their church or to their charitable organization. So they have $90,000 in total income. Their total tax bill is $11,646. So their after-tax income is $78,354. Now the difference here is, instead of paying the tithe now, they paid the tithe utilizing the QCD. This number here stays, so their after-tax income is $78,354. So if we compare the two, there's a tax savings of $2,200 in that year, which increased directly their after-tax income by that $2,200. So as you can see, there's just ways when you're looking at the income versus the expenses, how they're categorized, where the money's coming from, what it's being used for. You can utilize some of these tools, or in this case, it's just tax planning, just looking at, this is the amount that we pull from an IRA, this is what we tithe or give away to charity, and whatever that amount is, you can utilize that IRA, and then it's tax-free. So not only did you not pay taxes on it while you were working, it was pre-tax dollars, you don't have to pay taxes on it as long as it goes to a charitable organization. And for a list of what qualifies for a charitable organization, you can go to the IRS's website. Typically, they need to be a 501c3 nonprofit organization in order to qualify. But again, if this is something that interests you, I would definitely reach out to your financial advisor. I hope this helps explain the benefit of tax planning, even though a lot of people think that once they retire, they don't have income from a job or W-2 that tax planning is really irrelevant. This shows that tax planning is still important even when you're in your 70s. So until next time, guys, choose your advisors wisely. Your financial health depends on it.